If you have ever walked into a car dealership, you probably know this exact moment. You step onto the lot, you look at the sticker price, and maybe for a second, you imagine yourself driving that car home today. Everything feels exciting. The car is clean, the lights are bright, and the salesperson walks over with a friendly smile. Then they ask one simple question. How much are you looking to spend per month? At first, it sounds harmless. It even sounds like they are trying to help you stay within your budget. But that question is often where the buyer starts losing control of the deal. If you answer honestly and say, I would be comfortable paying between $500 and $600 a month, you have just handed the dealer one of the most valuable pieces of information in the entire negotiation. From that moment on, the conversation may no longer be about what the car actually costs. It may become about making the payment look comfortable enough for you to say yes. The dealer can move numbers around in ways most buyers do not notice. They can adjust the price, stretch the loan term, change the interest rate, or add extra products into the deal. And after all of that, the monthly payment can still land inside the range you gave them. On the surface, it may feel like you stayed within budget, but in reality, you may have agreed to pay thousands of dollars more over the life of the loan. That is why negotiating a car based only on the monthly payment is one of the most expensive mistakes a buyer can make. Now imagine you are standing in that dealership and you have already told the salesperson your upper limit is $600 a month. The car you are looking at costs about $27,000. In the original example, it is something like a Subaru Crosstrek with an MSRP of $26,995. If you finance the full price of that car with no money down over 5 years at a 6.5% interest rate, the estimated payment is about $528 a month. That means the car already fits inside your budget. In fact, it is not even close to the number you gave them. You said you could go as high as 600, but this car is already sitting comfortably below that line. The problem is, the dealer does not have to tell you that. Instead, they can begin guiding the conversation toward a more expensive version. Maybe they mention a higher trim with better features. Maybe they point out a package with tinted windows, floor mats, or other small extras you never planned to buy. Each one may not feel expensive when it is broken down into a monthly payment, but together, those little additions can quietly move you closer and closer to $600 a month. And because you already gave them that number, they know exactly how far they can push before you start to hesitate. One of the clearest ways to understand this tactic is through something called a four-square worksheet. Not every dealership will use the exact same sheet, but many of them use some version of it. The idea is simple. The deal is broken into four main areas: the trade-in value, the vehicle price, the down payment, and the monthly payment. At first, it looks easy to understand. As a buyer, your eyes may naturally go to the vehicle price, because that seems like the number that should matter most. And logically, it should. The total price of the car is what determines how much you are really paying, but the dealer often wants your attention somewhere else. They want you focused on the monthly payment. As the negotiation goes on, numbers start changing. A figure gets crossed out, another number appears, the down payment shifts, the loan term changes, the monthly payment drops. Suddenly, a deal that looked uncomfortable a few minutes ago starts to look manageable. But if you look closely, something important may not have changed at all. The actual price of the vehicle may barely move. That is the trap. A lower monthly payment does not always mean you save money. It may simply mean the loan was stretched out longer, making the payment look smaller while the total cost stays high. And this often happens after you have already been sitting inside the dealership for hours. You are tired. You want the process to be over. You can already imagine yourself driving the car home. So when the payment finally looks acceptable, it becomes much easier to say yes. But before you do, ask yourself this: did the car actually become cheaper, or did the deal just become harder to understand? There is another way a dealership can use your budget against you, and this one is harder to spot. It happens when you finance through the dealer and they mark up the interest rate on your car loan. Many buyers hear the words, "Congratulations, you were approved at this rate," and assume that number is simply the rate they qualified for. But that is not always the full story. In many cases, the dealer may have the ability to increase the rate from what you actually qualified for. That difference can become extra profit for them. This is not just an idea or a rumor. It has been documented before. In 2015, the Department of Justice reached a settlement with Honda because of discrimination in auto lending rates. The case showed that Honda, like many major auto lenders, allowed dealers to mark up interest rates. As part of that settlement, Honda agreed to limit dealer markup to 1.25% for loans of 60 months or less, and about 1% for loans longer than 60 months. Now think about what that means for a normal buyer. Let's go back to the $27,000 car. Maybe you actually qualify for a 6.5% interest rate, but the dealer comes back and tells you that you were approved at 7.5%. If you have not done your research, you may believe that is just the current market rate, but that extra 1% could cost you about $764 in additional interest over the life of the loan. And if the markup is higher, the extra cost can grow into thousands of dollars. So the real question is not only whether you can afford the monthly payment. The real question is this: was the deal built for you, or was it built around how much the dealer believed they could get from you? So what should you do instead? The answer starts before you ever walk into the dealership. Spending just 30 minutes preparing can save you a lot of money, because once you understand your own numbers, the dealer has much less room to control the conversation. The first step is to know what you can actually afford. Not a vague range, not somewhere between $500 and $600. You need to know your real number before anyone asks you for it. A helpful rule is the 20 or 410 car buying rule. That means you put at least 20% down, finance the car for no more than 4 years, and make sure your total monthly car cost, including the payment and insurance, does not exceed 10% of your gross monthly income. For example, if you make $84,000 a year, that is $7,000 a month before taxes. Under this rule, your total monthly car costs should stay under $700. Some people stretch the loan to 5 years because it feels more manageable. But if the car does not fit your budget on a 4 or 5 year loan, it is probably too much car for you financially. The second step is to look for financing before you go to the dealership. You can apply for pre-approval through a bank, a credit union, or an online lender. This gives you a baseline interest rate, so when the dealer shows you their financing offer, you have something real to compare it against. It also tells the dealer you are a serious buyer. More importantly, it reminds you that you do not have to use the dealer's financing. You can choose any lender that gives you the best loan terms. The third step is to control the conversation when the salesperson asks about your monthly payment. If they ask, "What kind of monthly payment are you looking for?" your answer should be simple: "I am more focused on the overall price of the car." That one sentence changes the entire negotiation. It tells them you are not there to play the monthly payment game. You are there to understand the real cost. And if you feel the pressure building, slow everything down. You can say you are not ready to buy today. You can ask for time to think. You can negotiate by email or text. You do not have to sign just because you already spent a few hours at the dealership. The car, or another one just like it, will probably still be there. The fourth step is to keep your car loan to 60 months max. Longer loans may make the monthly payment look easier, but they also make you pay more interest. They also increase the risk of becoming underwater, which means you owe more on the car than it is worth. If you need to sell it, or if the car gets totaled, that difference can come out of your pocket. The fifth step is to handle add-ons separately or simply say no to them altogether. Extended warranties, paint protection, wheel protection, fabric coating, and other extras are often presented in the finance office after the main deal feels finished. Do not let them get rolled into the loan without thinking. Gap insurance may be useful in some situations, but even then, you do not have to buy it from the dealership. You can compare options through insurance companies. And if you really want an extended warranty, you can wait and decide later, away from the pressure. The next time you walk into a dealership, remember this: the buyer who prepares for 30 minutes can save thousands of dollars. Know your numbers, get pre-approved, focus on the total price, keep the loan reasonable, and never let a comfortable monthly payment hide an expensive deal.